still think we're going to go back to that la-la land we were in for 40 years of deflation. And we're not, in my opinion, we're not. This is the 70s on steroids. There is going to be a lot of inflation in the next 10 years. And that's going to have enormous implications for all investment classes. That's going to be very positive for Bitcoin and gold.
You can be anything you want. When you have a 60% total debt to GDP, you can be the inflation fighting Batman, and yeah, you can take rates to 20%, but do that when it's 120% of GDP and growing, because our deficits, spending and fiscal spending and all this stuff, I build a bridge to heaven and a bridge to Pennsylvania from fucking Seattle. Hey, dude, can't fucking suck and blow, okay? You can either spend the money and go into a debt spiral, or you can keep interest rates artificially low, but you can't do both, okay?
Hello, everybody. Welcome to Swan Signal, the best place to get your Bitcoin signal, brought to you by Swan Bitcoin. My name's Sam Callahan. I'll be your host today. But first, I wanted to share some things that we're building at Swan that we're excited about. The first is we recently launched an app, so you can find that on iOS or Android. Download it. Let us know what you think. We think it's a great app to kind of just learn about Bitcoin, as well as buy Bitcoin, start a Bitcoin savings plan. So check it out. It's just on any app store that you can access. The other thing is we just launched Swan IRA. So it's an IRA product. If you look over at other proxies that you could get, like GBTC or mining stocks, we think that the Swan IRA product is a great way to get access to the underlying Bitcoin. You don't have to deal with any of those nuances or complications that come from investing in those proxy assets. And so check out the Swan IRA product today. And today we have a great show for you. So we got two experienced guests with us. We got Mr. Greg Foss and Larry Lepard. So Larry Lepard has over 40 years of investing experience. He's currently the investment manager at Equity Management Associates. And then we got Greg Foss, who brings 35 years of experience navigating the markets, primarily in fixed income. He's also a business owner and an investor, and just an all-around mensch. So welcome, guys. It's great to have you on the show.
Nice to be here, Sam.
Great introduction. Thanks for having us, Sam.
Yeah, Foss, of course. I just wanted to kick it. I just want to jump into it because there's a lot going on. Personally, I find the current market pretty difficult to read. If I'm being honest, it's very confusing and challenging time to read the market as an analyst. You have, stocks and Bitcoin are raging into the new year, but all of these macroeconomic indicators like PMIs, retail sales, housing starting to roll over, they're telling a totally different story than asset prices. So how are you guys reading these crazy markets right now? Let's throw it to Larry first.
Yeah, so I'm glad to hear you say that, Sam, and you're not alone. I mean, Dan Druckenmiller came out recently and said this is the toughest macro climate he's seen in his 40 years of investing, and I would have to agree. You just got so many cross currents. Traditionally, you would think that with all this tightening, that the economy would be in a complete tailspin, but there's so much free money still out there floating around that it's taking some time to have impacts, and you've got just a lot of conflicting data. So while I'm quite confident that we're on the right side in the longer term, and I think Greg would agree, as he says, it's simply just math. In the shorter run, it feels like anything could happen. Obviously we've been having a big rally in the stock market. It makes no sense. It's overvalued. Wall Street's still calling for higher earnings this year. I don't see it, not with the wage pressures and I think softer demand. The employment numbers are all over the place. Of course, they probably just make them up, so it's very hard to tell what's going on there. Inflation is definitely cooling, no doubt about that. But it'd be interesting to see how much it cools. I mean, oil's come down from 120 to 70-ish, but it seems to be pretty sticky in the 70 area. And now that we're not draining the Strategic Petroleum Reserve, that might reverse. So a lot of stuff going on. It's and of course you got a bear market in our stuff and the sound money stuff. But I feel pretty good about where we are. I feel pretty good about where we're going. But I don't know if we're going there in a day or if we're going there in 6 months or a year. It might take some time.
Yeah, absolutely. What about you, Foss?
So, yeah, I can't argue with Larry. The world has turned into a very short-term oriented in terms of the investing time frame. Everyone is a trader. Everyone is got FOMO in one direction or another. A lot of this rally, in my opinion, is driven by sector rotation coupled with your short covering. So what you have is value stocks had a bid going into the end of the year, and everyone was selling NASDAQ. But when you get offsaw on that, you get afraid of not being weighted to your benchmark. You tend to cover some short covering in the long duration assets, which are you think of tech stocks. But I think I can break it down into one simple trade. Larry, you tell me what you think. It's all a function of the DXY and the strength or weakness of the US dollar relative to other global fiat currencies. As you know, DXY topped out around 114 and had been on a decline since then. That was coupled with some stabilization in the equity markets and certainly risk assets, emerging markets. But coupled with that is going to be a very different outcome for the Fed, because as the US dollar weakens against there's only 6 of them in the basket. Primarily the euro and the yen are the two main counter or components. You'll have oil, which is priced US dollars. As the US dollar weakens, oil will strengthen, and that'll put pressure on the Fed because of inflation. So I like to break it down in terms of the DXY. When the DXY weakens, you see gold rally, you see risk assets rally. To an extent, I think the recovery in Bitcoin is a function a little bit of both DXY, and I don't believe it, but I don't believe in it, but the market does, in a risk-on attitude. So if I had to say one thing, I'd watch DXY as an indication of whether we're on the wrong side of the trade in the long term or not. The DXY is, I need to stress to everybody, all fiat currencies are melting cubes. It's just a relative rate of decay that is represented in the DXY. So the DXY means that the US dollar is not, it's certainly debasing, and it was debasing far less severely than the Japanese yen and the euro. But since the Japanese moved their peg on their yield curve control, that has caused the yen to strengthen. So we all know that it's a race to the bottom in fiats, but the DXY measures it as a relative rate of decline. Everybody knows when the DXY weakens, risk assets get a bid. So that covered with short covering. Don't overlook the long term. Hard assets win and DXY weakens.
Yeah, you're really seeing it. Yeah, you've seen the Dixie kind of drop into the Q4, and now actually just now we've seen it kind of spike back up, and now we're seeing some more headwinds to risk assets and things like Bitcoin after this recent rally. But Foss, you tweeted something the other day. It said, "In what part of your house does Fiat live?" In Debasement, which I just loved. But it's kind of like leads to this, like, all roads lead to currency debasement, which is why I think we all agree on this call that hard money is a place where maybe you'd want to be. And so, Larry, I'm glad you're here, because I wanted to talk about gold.
Sure.
Gold and Bitcoin are often grouped together as forms of hard money. Bitcoiners would say no, but other people would say perhaps gold and Bitcoin could rise together for a short period of time as both being hard money. Gold's been on a tear to end of the year, but now it's dropped off. It kind of tapped 1960, dropped down $100 or so. And we saw the highest central bank buying since 1967. Over 1,000 tons were bought over the last year. How do you view gold and Bitcoin? And do you see them competing against one another right now? Or do you think perhaps they could rise together or complement each other?
No, they're as I've always said, Sam, I mean, gold is analog sound money and Bitcoin is digital sound money. And Bitcoin's the future, and it's superior because its stock to flow will be lower, and it's got a lot of other superior qualities. But of course, not tomorrow, right? I mean, it takes this is a big transition, and it's going to take a while for the Bitcoin market to flip the gold market. But I think they will trade together. if you examine how they did in the 2020 period, gold moved first. Gold is more broadly distributed. I think it's pretty good at sniffing out turns in monetary policy. At least it always has been, as long as I've watched it. And my view is it started to sniff the fact that we're close to the peak rate, and that Powell, even though he's pretending to be Volcker, he really can't be Volcker, because he knows if he did so, he'd create the world economy. And so gold has started to sniff that out. And then what happens is, like in 2020, Bitcoin may lag a little bit, but when it comes on real strong and greatly outperforms gold. And I think that'll happen this time around too. So, they're trading very much similarly, and they can both win versus all other fiats. I mean, they're versus all fiat. I mean, they're very small in the scope. I mean, Greg and I argue about the size, whether you want to say the total market is 400 trillion or 700 trillion, it doesn't matter. There are trillions of fiat related shit in the world. And there's $380 billion of Bitcoin and maybe $5 trillion of tradable gold. I mean, there's more if you include what's in museums and stuff. So, it doesn't take much. I mean, they're both going to go up as we, debase, as Greg points out. So, I wanted to just add something else, though, kind of why it's so confusing right now. I mean, I just went and I checked my charts. I mean, this reminds me very much of the spring of 2008. I don't know how much people were around or active in the market at that time, but the market peaked out. The U.S. stock market peaked out. And I watched the stock market. Greg watches the bond market. I watch the stock market. They're both important, but the stock market tells you there's a lot of wealth effect in the stock market. And in 2007, the summer, the Bear Stearns funds blew up. And at that point in time, the housing stuff started to roll. And it rolled pretty hard from the summer of 07 into March of 08. And then you got a very nice bounce in the stock market. And everybody thought it was over, the correction in the stock market. And that bounce didn't last. I think that's what we're seeing right now in the stock market. And whether it goes another week or another month or 2 months, I don't know. But I think this stock market is going to roll and roll hard. And at that point in time, the market, in fact, the Fed futures forwards market is already saying that the Fed funds rate will be lower at year end, implying that, bad economy coming as a result of the 210 spread. And therefore, when that happens, when that bad economy comes, the Fed will cut rates, because it's more important. I mean, up until now, inflation has been the biggest problem. But as they redefine the inflation statistics, which they're pretty good at doing, the inflation is going to calm down. And as it starts to calm down, it won't get to 2, but they'll be able to say, well, it's on its way to 2. And then they'll say, we've reached our peak. Maybe there's one more hike. That's the market saying there's one more 25 basis point hike. That takes you to 5 on the Fed funds rate. And then by the end of the year, maybe you're cutting again. And, you get that going on, and people are going to realize, I mean, I've said for a long time, so I think Greg agrees with me, that when people realize that the government can never stop printing, I mean, Bitcoiners know that, gold people know that, but the average American doesn't really know it. They just know we've got an inflation problem. They think the Fed will solve it. When it becomes clear to them that they can't solve it, they're not solving it, that's the time at which the flows. And by the way, when the stock market, when their beloved stock market no longer rewards them for buying the dip, which it has really since 08, the stock market has rewarded all investors for buying the dip. And guess what? They just did it again. They just bought the dip again, and they've been rewarded here. But I think they're going to find out this time it's not going to work. And so when this stock market, so what I'm watching like a hawk is the stock market. And as this stock market rolls, then the wealth effect, the negative wealth effect is going to kick in. And, we're going to see the next leg up in these risk assets. And these risk assets smell it. I mean, Bitcoin's up 40%. That's the other thing. Look at year to date. Look at what's happened since October. Bitcoin and gold have been the 2 best performing assets. And, bonds have been a poor performing asset. Well, bonds have done okay. The dollar's been a terrible performing asset. And so, that's the future. And right now, the stock market is counter trend. But I don't think the counter trend is going to last, because you can't have earnings growth when you've got built-in 5 to 8% wage pressure, And so we're going to have soft demand, and one of the biggest inputs to corporations is their labor cost, and because of all the inflation, labor costs are going up very, very aggressively. So, and the stock market just doesn't realize that yet. I mean, and that's just because it's recency bias. It's all because of they're just looking back at the last 20 odd years where buying the dip made sense. and they're going to find out it doesn't make
sense. It has to be cheap, right? It has to be cheap, Larry, because it's down so much last year, right? It's got to be cheap, which is exactly absolutely the wrong way to invest. But
lots of people I've spoken to, I know they say, well, I was down 20% last year and that really sucked. But, they say you just got to hang on and take the good with the bad and this, that. Okay, fine. They haven't panicked yet. We haven't seen any capitulation in the stock market. But in a lot of cases, this is people's retirement savings. It's, it's all their savings outside of their house. And, they take another 15 or 20% hit on it. And they're going to have an oh shit moment. Right. And that's going to change things, I think.
Yeah, and they're not thinking about valuations, right? I believe the stock market is still at levels of the 2000 .com bubble.
Yeah,
right?
on a Buffett indicator basis, is at the 2000 level. The market's a GDP or the multiple of sales. It's still where the 2000 bubble peaked, and from the 2000 bubble peak to trough went down 50% in the S&P. The Nasdaq went down 80%. I mean, that's ARK. ARK's already done that, but there's a 50% downside potential in the stock market. And you wait, when that starts to happen, inflation's not going to be the Fed's concern. Preventing an economic catastrophe is going to be the Fed's concern. And we're going to be right back to all the stuff that they did with COVID. They'll be cutting rates, they'll end QT, they'll probably start doing subsidies, blah, 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 blah. Right. And that stuff is going to ignite sound money assets and commodities.
Yeah. Well, it's crazy because you look at the Wall Street estimates for earnings, and they still expecting earnings growth, right? Like 6% in 2023, 7% in 2024.
Yeah, my quarterly
and I'm looking at
this. I couldn't believe that. But again, think about Wall Street's in the business of doing. I mean, they're in the business of selling stocks. So they don't have incentive to be honest. They have incentive to make investors feel good.
Yeah, for sure. I would love we have two guys right here with a lot of experience, and I'm a younger analyst. I haven't seen an entire business cycle. You guys have seen multiple business cycles, and so I actually wanted to ask you guys get your experience about how right now compares to those global financial crisis, .com bubble, and some of these other periods of really volatile markets. Like, do you guys see comparisons, similarities, maybe in the market behavior, or how is it different today versus then? I would love to get your guys' opinion on that.
You go, Foss.
Well, Larry pointed out, so this reminded him of a time in the Great Financial Crisis. So, Sam, to be clear, the Great Financial Crisis, as Larry pointed out, started in 2007 with the liquidation or the gating of the subprime mortgage funds at Lehman and at Bear Stearns. And if you remember, you probably don't, Larry certainly would, it was the summer of 2007 when Jim Cramer went on his famous rant of, they have no idea how bad it is out there. Absolutely no idea. That, and he was criticizing the Fed. And so the Fed cut rates and rescued the stock market into the spring of 2008. So that's what Larry was talking about. Everyone thought the worst was over, but subprime did not buy it for one iota, okay? And so subprime continued to melt down, and that flowed through to Bear Stearns having to get taken over by Jamie Dimon and JP Morgan, and then they let Lehman Brothers fail. All of this took a period of over almost 2 years, to be exact, because it started in the summer of 2007 and ended in March of 2009 with the S&P hitting 666, okay, the sign of the devil. So basically you had that amount of time for the markets to figure out that things were not all rosy, and if just because the Fed cut rates didn't mean that asset prices and home prices couldn't go down. And in fact, structured product like leveraged super senior subprime mortgage structures couldn't go to zero. And many of those did go to zero. And that's because the system was so levered, right? Leverage allows things to go to zero because you are 25 times levered to your risk absorbing capital base. So it does remind me a little bit of 2007 and 2008. But what this really reminds me of more than anything is absolute denial of mathematics. So it reminds me of grade 11, where people don't understand the mathematics of a Lynn Alden tweet, for example, that I thought was the most brilliant that I've seen this year. And she sarcastically says, I can't believe the Fed published this, which showed a GDP level of debt to GDP that the Fed is projecting going forward, as if it's natural to have 400% federal debt to U.S. federal GDP, or excuse me, U.S. GDP. So let's go back to some mathematics. Larry said, and I know he misspoke because he said total gold market was 400 trillion. No, total financial assets in the world are between 400 trillion by Larry's methodology and 900 trillion by my methodology, because I'm a debt guy. I put all debt in there. Think of enterprise value versus market cap, okay? Nonetheless,
Gotcha.
We're splitting hairs when Bitcoin is 350 billion of a potential total addressable market somewhere between 400 trillion and 900 trillion dollars. We're getting too smart by a half in terms of how much Bitcoin could address this whole market. So I'm not going to argue with Larry over that. The only thing I'm going to agree with him on is that it's a spiral that cannot be solved. You have to print money. It is the error term. It's the only way of solving this runaway debt spiral where your debt burden is building organically because of the coupon on the debt. Okay, guys? If you don't understand that, you failed grade 11 math. So everybody's running around trying to split hairs. And the reality is quantitative easing infinity, QE infinity, is built into the mathematics. It always has been, and the Fed can pretend they're going into QT for the short term. It doesn't work in the long term. So there will be a solution where the Fed has to blink and admit, we have to print forever. So don't take your allocation to Bitcoin out of your gold basket. You take your allocation to Bitcoin out of your fixed income basket, because fixed income is a contract. And it's a debasing contract. It's built in fiat, and fiat is programmed to debase. So what are you going to take your allocation to Bitcoin? I don't care if there's Bitcoiners that don't like gold bugs and gold bugs who don't like Bitcoiners. You guys are missing the bigger picture here. It's so much bigger than the combination of gold and Bitcoin. It's about a Fed projection where they think it's normal that they're going to be able to borrow 4 times their revenue base or their GDP. That's going to solve this debt spiral. This is what blows me away, Sam. We have never been here before. The point of no return is past, so we cannot compare this anywhere in history. It started with a financial crisis. We rescued the system. First time in my life was the Latin American debt crisis. That's the first time we kicked the can down the road. Then it was long-term capital management. Then it was the great financial crisis, and then it was COVID, and now it is over. You cannot compare this time to any other time because our debt burden is just so darn large. The mathematics don't allow it to be solved any other way. So we can look back to different periods, but the reality is we've never been here before in terms of a global debt burden that is so large compared to global GDP. And you can break that down by country, and you could say, oh my goodness, here's the crazy thing. In the end of World War II, the USA had a debt burden, just the federal debt, that was right around 100% of GDP or 1 times. Hey, the USA was a trade exporter then, a global exporter. It doesn't work when you are a global importer. So again, there's no other time in history, because we have just been so irresponsible in building the debt burden. You can't compare it to any other time. I don't want it to go kaboom, but unless they keep printing forever, it goes kaboom. So there's one solution. Infinity, QE infinity, and we're going to pretend inflation doesn't exist because we're going to rewrite the definition of inflation to bring it down to this mythical 2%. Guys, inflation compounds, okay? Just because you can claim victory by bringing some stupid number down to a 2% annualized today, based on new mathematics, doesn't mean that you get out of jail for free for increasing it 15 or 25% annually on an equivalent basis a couple of years back. I have never been so sick to my stomach of the lying and fibbing that goes in. And anybody who's done any mathematics understands this, except they're not allowed to say anything because Ray Dalio gets on TV and says he doesn't think the solution is going to be Bitcoin, and then describes what he thinks the solution is going to be, and he fucking describes Bitcoin. Like, this is so asinine, and I've never seen anything like this. So we are living in clown world 3.0. Okay, and the people running this clown world need to be challenged by the people who understand mathematics. And it's not difficult math, guys. It's grade 11 math. So please keep challenging these people. They're lying through their teeth. It cannot be solved any other way.
Yeah,
Larry, you got anything to add?
Yeah, not really. Foss pretty much covered it. He's right. The problem's at the sovereign debt level, which is bigger than all the prior ones. You asked the questions, because we lived through them. How does this remind you of, the LATAM crisis or LTCM or the bursting .com bubble or 08? And the answer is yes. I mean, we've seen this movie before. It's bigger, it's deeper, it's more pervasive, it's worldwide, and it's not in any one sector. I mean, when the .com bubble burst, the rest of the economy was healthy. It was just the tech stuff that got hammered. Of course, it was an important enough part, it dragged down the whole economy. U.S. housing was not worldwide commerce. I mean, this is at a sovereign level, so it's much bigger, and it might take longer for it to play itself out. I mean, I must say, one of the things that surprised me is that it hasn't come apart by now, and that it's taking longer. But then I thought through it all, and I realized, when you grow the money supply by 40% in 2 years, which is what they did, that's a lot of liquidity. Do you know what I mean? And so there's still kind of a lot of echo boom around. And I think we all know, at least those of us who are watching this stuff carefully, we know where this is going. I mean, there's very little doubt. It's Greg's point that it's math, but we don't really know the rate at which it's going to get there, because there's just so much free money still flowing around. And, it's going to take a little while.
Or we can solve it that way too, Larry, right? Let's be clear. We can solve it that way too, by just continuing to print money, and then the only outcome is fiat debasement. Okay, so prepare for fiat debasement.
And I was talking to one of my kids today, and I said, look, I honestly, I think probably, inflation will be bad, but I think the healthiest way out of this whole thing for the entire world might be to actually, keep the economy running and let the inflation run hot until we can, inflate away this debt burden. Because, the alternative of everything blows up and we get an outright collapse, that's going to cause a hell of a lot of pain as well. So, it's unclear, because we know the policymakers are trying to walk that middle line between extreme deflation and extreme inflation. But to the degree there is a middle line, it has to be an inflationary one, because of what Foss talks about. The mathematics dictate that, right?
Yeah.
And be careful though, guys. Sorry, Sam, just to add, the only way that scenario works, where Larry says we inflate away the debt burden, is with a degree or a measure of financial repression, where yields are kept artificially or manipulated below the level of inflation, which is a Japanese style solution. And we know that doesn't work long term either. So it's just such a sickening prospect. So in that case, bonds are about the worst investment you could ever make in your life. And that being said, there's people who think that bonds are now a great purchase because, we're almost taming the inflation beast. I'm not saying short bonds, but I would not use bonds as a store of value instrument over time compared to other hard assets. Bonds are soft assets. You need to store your money in hard assets.
I think that's the big deviant perception that I see in the market right now, Sam, amongst professional investors, that people still think we're going to go back to that la-la land we were in for 40 years of deflation. And we're not. In my opinion, we're not. This is the 70s on steroids. There is going to be a lot of inflation in the next 10 years. And that's going to have enormous implications for all investment classes. That's going to be very positive for Bitcoin and gold.
It's worrisome to me, because I ask myself, like, who owns all these bonds? And to me, it's more older folks, right? Like retirees, pensions. You know, have they woken up to this change at all? You know, like, because it just worries me thinking about these retirees who think that they're safe in these risk-free assets with bonds. And there's this purchasing power risk. There's this real inflation risk. If
Yeah.
we are entering a period of financial repression, I mean, when are they going to think, when are they going to realize this reality, that we've had this huge shift that has occurred? Is it just going to take a long time for them to realize this?
No, I think sadly they're going to realize it in the next couple of years because,
Okay.
right now we're in a deflationary wave because Powell's trying to be, Volcker. But, we'll get, I mean, as Lynn also said in one of her great tweets, I have no doubt they can get the inflation down. What they can't do is keep the economy running, get the next wave of growth going without another wave of inflation. I mean, the notion that they're going to solve the inflation problem, that's the error. I mean, that's Greg's error function. You can't taper a Ponzi. You've got just way too much debt that will collapse. I mean, already the government itself is in a doom loop. I mean, the run rate on the government interest expenses is approaching $1 trillion a year. I mean, total tax revenues are $4 trillion. So it's 25% of tax revenues, and that's up markedly. A few years ago, that was 300. So that's more than tripled. And if interest rates go from 5 to 6 or 7, it's just game over. I mean,
it's already over. Over even with
well,
interest rates
true.
at the current level. So I guess we don't have to get too fancy, but it's a great question, Sam. Look, the people that own it, everybody, because everybody has a 401k that's managed by some sort of advisor who always goes by the 60-40 rule. 60-40 has always worked. You know what? 60-40 has worked for the last 40 years because the 40% that were in bonds were invested starting at rates that started at an 18% Volcker era inflation fighting level and went down to close to under 1% in the USA, and in some cases in Europe, negative. Now, try to describe a bond that's a saving instrument that produces a negative yield, and you've rewritten the laws of finance, okay? Because that's not called an asset. That's actually called a liability, where you have to pay money to keep your money in this instrument called a bond. Well, they managed to do and pull the wool over everybody's eyes for so long, but when do people wake up? When there's a crisis like what happened in Great Britain, and there was an investing strategy that was built on leverage and levering long bonds to increase their return. And guess what? When you lever something, not only do returns increase, but negative returns increase. So they lost 3 times their money. They lost 100% of their value over a short period of time because they were levered. So that's when people start figuring this out. And then they go to their government and say, please rescue my pension. And the government says, well, you know what? I want to get elected next year, so I am going to rescue your pension, and I'm going to pretend that it was a good thing to do, except what did they really do? They kick it upstairs to the coffers of the government. So every financial crisis always kicks the financial responsibility one level higher to the level of sovereign debt, the government. Well, guess what? There's no further place you can kick it now, and that's why we are where we are. You've consistently kicked the problem up a level to reside on the balance sheets of the sovereign debt nations. It's going to collapse, and it'll happen in stages. I'm not predicting the end of the USA Treasury market anytime soon, because you're going to have to see the end of the Canadian bond market before that, and you'll have to see the end of a lot of other bond markets before you see the end of the Canadian bond market. It'll start at the lower nations and work themselves up to the G7 nations eventually. And if the USA doesn't get its acting gear and put some Bitcoin on its balance sheet and also endorse Bitcoin as a store of value, while at the same time defending the US dollar as global reserve currency. So you'll have a reserve asset called Bitcoin. You'll have a reserve currency called the US dollar. It can still work, but you better start planning for it right now. Not happening tomorrow, luckily, because there's no other alternatives. But you'll see these weaker nations gradually fail, and you'll see a G7 country like Canada fail, and then I'm going to move to the USA if you guys have me. But Larry will be keeping me at the border, not allowing me to come down because he doesn't want more immigrants into the United States. So we got to solve this whole thing, right? And it happens piecemeal. It happens in steps, but eventually everything always goes to the top rung of the risk takers. And by the way, there's no such thing as a risk-free asset anymore. And Luke Groman, a friend of both Larry's and mine, writes about this often. U.S. Treasury debt is not risk-free. If it was, why are people then paying for default insurance on the U.S. Treasury bond? There are people that are out there buying default insurance on the U.S. Treasury bond. That's not a risk-free asset, people, because paying something for it. They view there being a very small but not zero chance that the U.S. Treasury defaults. So be very careful with the definition of risk-free. Does not exist anymore. Never did exist. It was just taught to us in school that it was actually that way. And then we go out and we start practicing this financial chicanery. And then we realize, holy shit, you can't keep printing something forever without eventually paying the piper. So you see it happen in third world countries, and then you'll see it happening in developed countries, but not the USA. But the mathematics works everywhere the same way. Debt is a disease. It's a fiat disease. And this disease is starting to eat the carcass right now. So be very careful. There is no such thing as a risk-free asset, except Bitcoin. Except we don't measure it properly, but Bitcoin is actually your risk-free asset. Nobody has thought about that yet.
Yeah.
I thought about the risk-free yield of Luna just immediately when they were saying how that was risk-free too, huh? Oh man.
Well, that was the Fiat Ponzi recreated. That was a centralized shitcoin recreating the Fiat Ponzi.
True. Let's pivot a little bit to the recent FOMC meeting because it kind of touches on what we're talking about here. I think some market participants wanted Powell to push back a little bit on these rising speculative markets, especially after how much money was printed the last several years. But he didn't really. He kind of contradicted himself in that press conference. He spoke about how it was almost a premature victory on inflation, how it's very positive that they're seeing all this disinflation everywhere. And then at the same time, he said, well, there's still inflation, though. It's still high. So he kind of contradicts himself, but the market liked it. And market, assets rallied after that presser. And financial conditions continue to loosen over the last couple months. I wanted to read a short thread from this FinTwit account, Carlo Cassio, Kitty. Yeah, he's great. He's great. But I wanted to get your reaction to this. He says, the Fed committed a massive policy mistake by not pushing against market pricing cuts that started in Q4 2022. While they used all sorts of spurious bullshit to dance around their transitory, disastrous fallacy, they are now the only possible recipient of blame. With rising net disposable incomes, fiscal and monetary impulses fully faded, labor market burning hot, all-time high home equity, available excess savings, stocks still high, inflation is about to accelerate, and they are firmly behind the curve. How long they remain behind the curve will be crucial in determining how high they need to hike. But whatever that number is, it's much higher than the current terminal. And so what do you guys think of that take? Because I kind of agree with him. I lean towards that inflation is more entrenched than they think. It's going to be stickier than think with these, labor's super tight and got a lot of wage pressures. And I think that they're probably behind the curve and they'll probably actually need to hike higher than they expect to. What do you guys think?
I think that is accurate, and that's what they should do. But I think what they're setting themselves up to do is to rejigger the inflation numbers, claim victory, even though they don't have victory. They're making a bet that the economy is going to slow down, and I think the economy will slow down. There's a lag effect. And I don't think they'll go beyond the 5 or 5.25 terminal rate. And then we will get another wave of inflation, and their figuring is they'll deal with that when that happens. That, it strikes me when I looked at Powell and what he said in this last presser, I think, and Roman said this in one of his most recent letters, I think he realized how trapped he is. And I think he's chosen to try and pretend to be Volcker, but not really be Volcker, and let it run hot. And he'll just say, look, he'll try to pretend that he's been a hard ass, even though he hasn't. Remember, Volcker had to take rates to 20%. We're a long ways away from 20% to tame that inflationary psychology. So I don't know how he realistically thinks that being at 5% is going to get us where he wants to go. But I think he's aware of how at risk the economy is if he goes a lot beyond that. So I think he realizes he's going to be Burns, and he's going to let it happen while using rhetoric that makes pretending to be Volcker. And when it doesn't work, he's going to blame it on the market or something other than himself. My guess is he'll get out and pass the baton to somebody else.
Yeah.
So
what do you think, Chris?
Let's be careful, because Volcker had a total debt to GDP number that was in the 60s, and Powell
30.
has a total debt to GDP number that's twice that size, 120% of GDP. So it's absolutely impossible for Powell to take rates to 20%, because then the debt spiral just implodes at a much faster rate, okay? These are the numbers. The last 2 years, the average coupon on the government debt was 1.5%, okay? And the interest burden was $400 billion annually. Now, with a combination of higher debt levels because of deficits, as well as higher interest rates, the average coupon is going to be 3%, and it's going to be close to $1 trillion annually, as Larry mentioned. That's at 3%, guys. That's $1 trillion. That's 25% of tax revenues. Wait until the current 10-year rate rolls into the funding as an average funding rate, and you're going to be over 1.2 trillion. That's at a 4.5 or 4% rate. Put the same number in there at 20%, guys, and you are running a deficit that is 5 times larger than your total tax revenue because of the interest burden. Now, please, guys, stop, full stop. You can be that guy who just did that. I'm not sure who he was. It sounded funny. The problem is, when you realize how the math works, you're like, it's impossible. You cannot do this. So there was the guy from Starwood Trust. Who's the guy? He was on with CNBC, and he's doing the math with Joe Kernan. Barry Sternlicht. And he's doing the math with Joe Kernan and knucklehead Alex Ross Sorkin and Becky Quick. And he's running through the math, and you can see these guys, and they're like, whoa, oh my God. And then they sort of, okay, cut to commercial. Okay, we can't actually tell the U.S. audience the mathematics behind this. Go to commercial. Get them off the air. They hook them off or change the subject because the math doesn't work. So you can be anything you want. When you have a 60% total debt to GDP, you can be the inflation fighting Batman, and you can take rates to 20%. But do that when it's 120% of GDP and growing, because our deficits, spending and fiscal spending and all this stuff, I build a bridge to heaven and a bridge to Pennsylvania from fucking Seattle. Hey, dude, can't fucking suck and blow, okay? You can either spend the money and go into a debt spiral, or you can keep interest rates artificially low, but you can't do both, okay? So I just am so sick of this fake mathematics. And when the people on TV finally point it out, they don't want to listen. They're like, oh, please tell me that's not true. It's like me having a 4th credit card to pay the interest on my first 3 credit cards. You think that's actually responsible fiscal governance? No. Well, that's exactly what the government's doing. So like it or not, even if inflation runs hot, you can't fight it by raising rates. Why? Because you'll just accelerate this debt burden, and they could keep printing money to do it. It just means your debasement accelerates as well. So all paths lead to Bitcoin and hard assets. Never seen a simpler trade in my whole life. That being said, no one else is listening. So
sounds like opportunity.
We're listening. Awesome.
Yeah, I'm listening. That was great. So what do you say to Charlie Munger then? because Charlie Munger is going writing Wall Street Journal op-eds calling for an outright ban and praising, the CCP for their, reaction to Bitcoin. If Charlie was in the room with us right now, what would you guys say to him? Larry, I'll let you go first.
I'd tell him to go fuck himself. I mean, I think he's a fucking asshole cantillionaire. I mean, he's said so many evil things. I mean, the guy, I absolutely hate the guy as a prick. Basically, he got rich off a fiat system that he played like a fiddle. And as my friend Mark Juskovic said, he wants to pull the ladder up behind him and let everybody else, suffer. He doesn't see any of the benefit of Bitcoin. He conflates Bitcoin with crypto. He's a cantillionaire. He's a perfect example of what he himself said, which is, show me the incentives, I'll show you the outcome. Well, the incentives for him are to live in a fiat system where he gets cheap access to the money. And that's what he's done. And he's used that to create, hundreds of millions for himself, and if not billions for himself, but at the expense of the rest of the world. And, I find it very objectionable that he defends that system, being smart enough to know how evil it is and how much it's benefited him. So I have nothing nice to say to that guy. I think he's a piece of shit.
Well, I love being on with Larry because I'm going to actually say something that's going to be less pointed, but I'm not very good at having tact as well. So I've already told Charlie on another podcast he can go fuck himself as well. So Larry, I'll agree with you on that. But Charlie is a cantillionaire who understands the system and has made a lot of money off it. I'll agree with that as well. But he's giving poor advice to my children and my children's children. And for that, I'm very disappointed. Because if he does truly believe what he's saying, then he shouldn't be in a position of power like he is. And I believe he actually knows what he's saying and therefore is trying to, as Larry said, benefit him at the expense of a lot of other people in the world. So the only good thing I can bring to this discussion is an expression that I said today on a Swan Bitcoin Spaces with Alex. I said, Charlie Munger should not buy green bananas. And what does that mean? It means he may not be along long enough to see those bananas ripen. And that's a good thing so that we don't have to listen to his drivel anymore. And time takes care of a lot of stuff, okay? So Charlie Munger will go away in due course because no one lives to infinity. Only Bitcoin goes to infinity, but Charlie Munger's time on this earth will pass, and we won't have to listen to his backward-looking view of life, and we can start looking forward, or we can start looking to some forward-looking views of people who understand how technology actually works, not someone who came into this world where the horse and carriage was, the primary mode of transportation. So I wish the man a happy life for the rest of his life, but it's not statistically going to be that much longer. So luckily, we don't have to listen to his drivel about how he made money on a flipped system. Give proper advice, Mr. Munger. I think you're probably a good person, but this spewing stuff about evil and then praising the Chinese government, man, oh man, someone's spiking your protein shakes with some fucking evil shit because you are telling absolute garbage to my kids and my kids.
Yeah, I don't know how you get to the good person part, Foss. I don't see any of it. Yeah, I mean, anybody who believes that the government should be able to ban something, ban software, ban code, ban speech, I mean, that's just so anti-libertarian, anti the correct ethics of my view of how the world ought to operate, that I have no tolerance for the guy whatsoever.
Yeah.
I don't listen to him. I don't, I mean, praising the Chinese government, for banning something. Okay, fine.
Right.
Not what I believe.
Yeah. I don't wish the man ill will or anything, but it does remind me of, the quote, like, innovation progresses one funeral at a time. Yeah. And that's kind of what I think about here. So we'll see. I don't think he's going to be around to see hyper Bitcoinization, unfortunately for him, but we will. So let's move on to something that you guys are both working on, that I think is actually really cool, which is the Bitcoin Opportunity Fund. from my understanding, this is only available to qualified accredited investors. But you guys are building this thing with a few other people like Corey Clipston, Mark Moss, David Foley. Why are you guys starting this fund now? And why do you think it's a good idea? I would love to hear more about it.
Yeah, let me take that one. Look, our view is that there are, that what's going on in Bitcoin is big, important, and that while there are some outstanding small Bitcoin venture capital funds, there's no hedge fund or investment vehicle with highly experienced partners focusing on the broader Bitcoin investment opportunities all the way across the capital structure, debt, options, equities, Bitcoin itself, and later stage deals. And so our belief is that there's a need for a fund to fill that gap. And so we put together the best team of people that we could find. We all threw money in, we all threw our hats in the ring, and we're going to directly invest in these opportunities as we see them arise. And we think that there are a lot of pools of capital that want experienced managers to help them sort through and capture alpha in the Bitcoin space. And James Lavish is kind of the senior partner in terms of day-to-day operations. Foley's right behind him, and then Greg, myself, Mark, Corey, et cetera, are all kind of advisors, and we're all going to participate in the investment process. So it's our belief that we can add real value in making the right choices for people who want to bet on Bitcoin over and above the coins. I mean, obviously buying the coins themselves, great investment, no brainer. But there are a lot of opportunities outside of the coins that we've been identifying, and we think that there's a need for an institutional product. Is that accurate, Greg, from your point of view?
I'll just add this, Sam, that yes, it's a very qualified team that have seen their share of investment cycles. The cool thing about Bitcoin is the investment cycle of Bitcoin tends to be a lot shorter than regular economic cycle, okay? And you've seen some peaks and valleys in the price of Bitcoin. That being said, I still think it's, these are rounding error prices for Bitcoin. But what you need is an experienced team that understands that over any cycle, there are times when you should be a better buyer and a better seller. And one of the things that I like about this product is we're actually going to be able to short traditional finance businesses as a hedge, because the economic cycle of traditional finance is right now moving into an area where people are overpaying for traditional finance assets and underpaying for Bitcoin and Bitcoin ecosystem assets. And we think you can hedge the two. And it'll take time. This is a product that there's an expression, Sam. When they're throwing money at you, you should be giving them the money back. And when you're asking them for money, nobody wants to give you money because they're scared, right? That's why prices move in the opposite direction of supply. So at the top of a market, everyone's yelling, they're begging you to start a fund at the top of a market, meaning the high price. And then at the bottom of the market, when you should be starting it, which is where we are starting it right now, most people are scared. They have their hands in their pockets. They've been, there's with TradFi assets or with the digital assets. This is where we take a long view on it, and we're establishing this fund over a period of 10 years where we think there's going to be a lot of different opportunities, whether it's the shorter cycles of Bitcoin and Bitcoin mining or the longer economic cycles of a traditional bull-bear market in the economy. We like to match those two. So Larry's got a lot of expertise, myself, Mark Moss, Corey Swan. It's a bit of a goofy statistic, but we easily get over 100 years of investing experience. I'll couch that by saying this, Larry. The only thing I bring to the table is 35 years of mistakes, okay? That being said, I've never let any of these mistakes kill me, and managing risk is all about changing your investment thesis as the information changes, okay? So that's what I like to say, that we're going to be part of this, where we have a experienced crew. It has lived through their share of crazy markets, either stupid cheap or stupid rich markets. And all we can bring to the table is our investing acumen that will try to reduce risk and maintain the same level of return, or alternatively, increase the level of return for the same level of risk. It's both things happen when you bring an experienced management team to the table. I look forward to the day when large pools of institutional money will look to invest in this type of asset or fund. The truth is, you have to have a 5-year track record to attract any serious institutional money. And at a 5-year track record, you have to start it. And so we're starting it. We're going to get high net worth individuals and accredited investors at the outset, but hopefully 5 years down the road, this will be the investment platform of choice for really big pools of capital. And Larry and I and Mark and Corey will play second fiddle to the expertise of David Foley and James Lavish. But those two guys in themselves are some very experienced investors. So I'm happy to be part of it.
Yeah, Sam, the timing is good, right? We're in a bear market, so that's the right time. I mean, we're seeing some really outstanding opportunities. And so our belief is that people who are willing to invest in a bear market, are going to reap the rewards of that. And as Greg points out, we're going to move around such that we're going to try to take down the risk. When everybody's totally overexcited and everything's going nuts, we're going to be on the other side. We're going to be dialing it back.
No, it sounds exciting, and trying to beat the benchmark Bitcoin.
Right.
But if there's any team to do it, it's you guys with your experience, and talk to James about it as well. And it's really exciting when you look out at the industry and all the opportunities, all these distressed assets, and the prices of say public mining companies are just in the gutter, and everybody else, all these other VC funds seem to blow their load, if you will, during the bull market. You just see it in their funding and the amount of deals that happen. And now there's not a lot at all. So that's perfect time to start a fund like this, right?
And we will own some of the coins. And I mean, like an example of the kind of thing we could do, we're so confident about the coins longer term that right now we could write puts on Bitcoin at 16, 15, 14, 10, 9. And our view would be, and so if it never goes there, we'd collect those put premiums, right? But in turn, my view is if Bitcoin goes to 9, back up the truck, right? I mean, we'd be very happy to write those puts and have the Bitcoin put to us at 9, because we're quite convinced that it's not going down to the prior low of 3,500. So that's the kind of thing that we think we can do that will, again, as Greg says, kind of create a better risk reward trade-off, so you can invest in this area in a sane way, in our view.
Yeah. Bringing that risk management and
we got to be careful, Sam.
And you guys have a ton of network, right?
Well, we got to be careful. Sorry, we got to be careful. Our benchmark will not be to outperform Bitcoin per se. It will be to provide a superior return for a lower level of risk. And that's, there's a lot of people that just can't stomach the volatility of regular Bitcoin. And so whether you write puts or you write covered calls, whether you play volatility strategies and extract vol from the options market, all of these are things that can be accomplished, but you actually have to have that platform to do it. So we're excited to try and attract some money and prove that we can add value, and as Larry says, add alpha on a calculation like a Sharpe ratio relative to the volatility of Bitcoin, et cetera, et cetera.
Exactly.
Yeah, that's a great correction. You guys are aiming to maximize risk-adjusted returns.
Correct.
Which is great. I got one more question for you guys real quick. A popular book is The Fourth Turning in Bitcoin by Neil Howe and William Strauss, and they talk about great champions in there, and that's the profit generation. That's your guys' generation. Great champions are people who are active during the fourth turning, sharing their wisdom and experience and reminding us of the big picture. And that's what I look at you guys, and I consider you guys great champions, respectfully, of course. So I want two questions for you guys. One is, what would you say to your fellow, baby boomers, people of your age who are watching this, who are just getting into Bitcoin? And then also, what advice would you have for younger people, let's say like Gen Z and other young folks just entering this market and investing in general right now. So maybe a piece of advice for the young folks, and then a piece of advice for your fellow baby boomers or people of your age who are getting into Bitcoin.
Go first, Foss.
Well, sure. It's a great question. So for both cohorts, I would say you need to study. You need to understand that when something like the automobile was first introduced, people said, what I really want is a faster horse. I don't want this thing called an automobile. I want a faster horse. And then they realize, okay, technology changes things. For both cohorts, understand that the world is going to change parabolically. There's a Luke Broyles is a new guy that I'm starting to follow on Twitter. Had a great thread about how we currently have more in common with the man or woman that grew up in the year 23, so 2,000 years ago, than we're going to have in common with the person who lives 100 years into the future. So in the year 2123, that's how fast things are changing. So understand that there's a level of acceleration of technology that's going to change the world so much that you can't possibly think that Charlie Munger has any fucking clue what he's talking about, okay? That's the opportunity for both cohorts. Now, the people that are going to embrace it more are going to be the Gen Z. You have longer to live. You can afford to lose some of your savings if you're wrong. But Bitcoin, don't shitcoin. And the only wrong allocation to Bitcoin is having zero, or God forbid you're short this thing because you're too smart by a half, okay? Understand that Bitcoin could be the greatest asymmetric trade opportunity and investment opportunity I've ever seen in my life. And you're supposed to own some percentage of your portfolio. I argue that you got to start at 5% and you should be comfortable owning between 5 and 10%. That's for both cohorts. Larry and I own a little bit more than that, but neither of us own 100% because you don't have to own 100%. Participate in the asymmetry of the upside of this great trade and investment opportunity. Don't overthink things. Understand you got to learn and you got to manage risk properly.
Yeah, I would just say to both my cohort and the younger cohorts, take the time to do the work. I mean, the thing I've been most surprised by is how some very successful people who've done very well in the investing game haven't done their homework. I mean, it's just like, really? I mean, this is an amazing technological innovation. It really is. That's what it is. It's a new, we solved a bunch of guys, because I think Satoshi is a group, not one person, solve the issue of immutable digital scarcity beyond a doubt. We've got 750,000 plus blocks that prove that. We've got 14 years of error-free transactions that prove it. And it's a big, big, big deal. It is like an airplane or a car or a printing press or whatever it might be. Digital scarcity is going to change the world. Bitcoin is going to change the world. And so what I would say to most people, I think far too many people my age particularly, but even many younger people, they blow it off. They just kind of like, yeah, whatever, FTX, crypto, bunch of bullshit. They don't take the time to dig in and differentiate and understand what it really is. I mean, I think the first thing I would just say, and most people who are listening have probably already done this, but I always start off by handing out copies of the Bitcoin Standard by Safe. I mean, I think that's, the most compelling argument for Bitcoin ever written. I think that book will go down in history. I think the entire country should read that book. And it's as important as the fourth turning. And then I think once that gets you started, then you work towards your X thousand hours of really understanding all the issues, the difficulty adjustment, the halvings, the adoption, the use cases, remittances, et cetera, et cetera. I mean, there's a perfect example. I mean, Charlie Munger thinks Bitcoin is evil. Oh, really? How about all the poor people in the world who live in currency regimes where they basically have their money stolen from them constantly, and yet Bitcoin provides them with a sound money alternative? I mean, he doesn't think about guys like that because he doesn't interact with people like that. He interacts with billionaires. So, I would just say to people my age, young, it doesn't matter what age you're at, You've got to take the time to do the work and understand what this thing is. Because once you understand that, you will become as enthusiastic as all of those of us who do understand it are. It'll become self-evident to you that we're not preaching here. We're just trying to educate people about something that appears obvious to us. And that once you understand it, it will probably appear obvious to you as well. And then you'll go, oh, I get it. And by the way, everyone buys Bitcoin at the price they deserve, right? And so the sooner you understand it and you start making an allocation to this, I mean, today, it's within the reach of many, many people to be a whole coiner. I suspect that my grandkids will say, holy shit, you're a whole coiner? And because there won't, being a whole coiner, when being a whole coiner, it costs $1 million, there aren't going to be a lot of whole coiners, right? And so, it's going to change, right? And we're still, everyone says, well, I'm too late. I hear about these stories of people who bought it at 300 or whatever. Well, it all depends. I mean, if it goes to 10 million, are you too late buying it at 20,000? I don't think so. So I would just suggest that people take the time to do the work. That's what I continually emphasize to people. I mean, I had dinner with some 80-year-old guys the other day, and I sent them money on a Moon wallet, and they were blown away. They were like, hang on a second, there's no bank involved? Right. How much did it cost you to send me that? I was like, well, it was like 17 sats. It's like a fifth of a penny or something. They're like, no. I was like, yeah. I said, can you see how this is going to change the world? Yeah. I mean, they kind of got it. And they both, by the way, they both ended the dinner like, well, how do I buy this? And I led them to Swan, and off we go. But the point is that it's going to happen. It's inevitable. And so, you can decide you're going to ignore it, and that will be costly as an error, or you can decide you're going to understand it, and that will, I think, benefit you. So that would be my advice.
Yeah, just made me think. I think even Bitcoiners almost like take it for advantage how amazing it is that we could send money so quickly without any intermediary. Like we've almost gotten used to it, right?
Right.
But it's an amazing thing, and for people who first experience it, like your friends, I mean, it's just mind blowing.
Yeah, they were like, "What?" I mean, I pushed the button
bank.
and it was in their account. Yeah.
Yeah.
And look, we've got Venmo and we've got PayPal, but this was like, I was like, nobody knows that we did this. Nobody can trace this. It's all on Lightning, as we all know. It's powerful. It's really powerful. Yeah.
Yeah, and you got to do the work. You can lead a horse to water, but they got to drink it themselves.
Yeah, and there are lots of FUD merchants who are trying to prevent you from doing the work. And generally speaking, those FUD merchants have a vested interest in the old system, right?
Amen to that. Well, thank you so much, guys. You guys have both been really generous with your time. Where can people follow you if they want to catch your tweets or
hey, Foss, are you back on Twitter, or are you still on holiday?
I'm doing my best to I'm doing my best to regulate my involvement, but yeah, I still look at DMs on Twitter, and I occasionally tweet. I have to retweet brilliant stuff by Lynn Alden and yourself, Larry, and James Lavish. But yeah, I'm on Twitter, Sam. Actually went to Noster, but I have no idea what I'm doing, so don't go to Noster yet. But I want to add one thing. For all those people that think they're too late, I will categorically state that Bitcoin is less risky and a better investment today at 23,000 US dollars than it was when I got involved in 2016 at $1,000. Okay. Why is that? Because we've seen the response to government to this thing called the COVID crisis, which absolutely makes fiat debasement 100% certain. It's just the rate of acceleration of the debasement. So you're going in this spiral and it's coming quickly, people. Don't overthink it. If you listen to Charlie Munger, you're a fool. Charlie Munger has no clue what he's talking about. And if he does, it's because he's a conflicted idiot. So listen to the kids, listen to people who understand the technology, and welcome to the greatest financial innovation ever, Bitcoin.
Larry, where can people find you?
You can't top that. I'm on Twitter at Lawrence Lepard.
Yeah, you're on Twitter. Just
go there, and my website's there too. I write quarterly letters. They're free. Talk about macro.
Yeah, they're great. They're great.
Thanks.
Well, thanks, guys. And, if anybody's interested in what they're building at the Bitcoin Opportunity Fund, again, it's for qualified accredited investors. You can go to bitcoinopportunity.fund if you're interested in that. And just thank you guys so much for joining me today. It's been a great conversation. If you like this, make sure you subscribe to the Swan Bitcoin channel so that you get notifications so you don't miss any of our upcoming content. We have some great shows lined up for you coming up over the next couple months, so you're not going to want to miss it. So if you're listening on a podcast or on YouTube, make sure you like it, make sure you subscribe it. We really appreciate the support, and I'll see you next week.